Hello, my name is Charles-Henri Sabet. I am going to talk to you today about my views and forecast about the first quarter 2010. The combination of better than expected growth and lower than expected inflation should be good news for financial markets next year. The regional growth outlook suggests that domestic demand in countries like Brazil, Russia, India and China and the wider emerging world will continue to show strong leadership, while domestic demand in the G7 remain relatively sluggish. Also, the financial market outlook is much better, and this should be positive for what I will call risky assets. Debate about inflation and deflation is important. Some think that a large upswing in inflation is inevitable as a result of central bank balance sheet expansion, escalating fiscal deficits, and rising commodity prices. That is one of the reasons of the high price of gold today. The other believes that the credit crisis and its aftermath will usher in an era of sustained Japan-style deflation, especially in the US and the rest of the developed world. And that's why 10-year interest rates, bonds, are so high. I'm personally less optimistic with respect to growth, and despite being optimistic on crude oil, gold price and other commodities, I think that the price is moving, the world is moving, and other commodities price are more an adjustment than inflation. In countries like China, Brazil, Russia and India, despite a growth optimist, I do not see any inflation, when in Japan and the US, if we ignore commodity price, I'm more afraid of a deflation. We will then need to be opportunistic and take advantage of the low interest environment in the G3 and invest in the new countries. Let's talk about the US dollar. The US dollar is a weakening currency, and as long as the decline is done in an orderly manner, it does not hurt anyone. It is very unlikely that any orderly dollar decline will lessen its near-term role as the world reserve currency for one simple reason. There are few viable alternatives. In the short term, no other currency offers the size and liquidity, not to mention the political and legal stability, necessary to match the dollar as a reserve currency of choice. In the longer term, US dollar reserve dominance may be challenged by other currencies that will likely rise in importance. But for now, an orderly decline that helps the US economy rebalance into a sustainable growth and a debt dynamic may help prolong its importance as a reserve currency. So a gradually weakening dollar may help heal the US economy, stimulating the US job creation and help reverse the build-up of global imbalances that are the root of today's economic crisis. Investors should then expect and position themselves for further US dollar weakness again. I want to talk to you about the portfolios. In terms of currencies, I would like to short US dollar, I would like to short yen, I would like to be long euro, to be long Aussie, I would as well be short New Zealand. As I see the volatility going much lower in the currencies, especially in the G7, I would sell strangles in euro dollar especially and in other G7 currencies. In terms of equity investments, I would invest in Brazil, Russia, India and China using ETFs. That is much easier for us than doing stock picking. Then, to avoid any systemic risk, I would short some S&P and some FTSE. In terms of interest rates, I would take advantage of the spreads of the corporate bonds, but I would not invest in more than 3 years. I would as well buy some Venezuelan bonds, and to hedge all that, including the equity, I would buy some 10-year US T-bills. In terms of commodity, I like to invest at least 20% of my assets in gold and in crude oil. Don't forget that all this is forecast and you should manage your risk and your investment as you can. I wish you good luck and good trading.